Okay, so let's go ahead and take a look at the macro position for Bitcoin. This is a chart that I guess has been around for a while. We've kind of talked about this pretty much since 2022, and there's lots of interesting things in here. I'm going to try to go through these data points and kind of give you my kind of thoughts and opinions on it. Now, this is a messy chart because, well, it should be. There's a lot of things going on here. We can obviously tidy this up a little bit and kind of not explain certain things if we wanted to, make it really easy to read, but essentially I think everything on here is critically important to know about. So what we're going to do is we're going to jump into this. Now, as I get into it, if you find it useful and informative, smash the like button. If you're new to the channel, then why not go ahead and subscribe? What have you got to lose? You can always unsubscribe later. And of course, you know, if you haven't yet joined us in Discord, check it out. Link is in the description below. Let's make a start with this thing then. So Bitcoin paired up with USD on the 1 week time frame, and Bitstamp is our data source. So that gives us this big macro view. Okay, and you can see we have 2013, 2017, 2021, all those peaks that we see there. We also have all of the crashes and the bear market lows, everything from 2015, 2018, potentially 2022, but we'll see about that. And yeah, so let's kind of take a look, right? So we've got the green lines. The green lines are your Bitcoin halving events. Okay, the next one being approximately week commencing the 1st of April 2024. We can see here with the 11th of May and the 4th of July 2016 and so forth, right? So you have all the halving events. Let's go ahead and focus in down here to start with, right? So Bitcoin starting its journey. Now, Bitcoin starting its journey, we've got data as of the 15th of August 2011. You can see how it was very volatile. Basically, you know, it was like $7 per coin, right? And the Bitcoin halving event in itself basically halved the amount of Bitcoin that you could mine through verifying transactions. Now, back here, this was really important because the amount of Bitcoin that you were earning through mining was very, very high. So halving that amount is quite impactful on the small circulating supply that's currently out there, right? If you've got a really small circulating supply and all of a sudden the new minting process is halved, then you're going to have an impact on the supply-demand metrics, right? And it's going to be quite shocking. And so you can see here that this started a bit of a trend moved to the upside, big explosive move to the upside, in fact. And we can see from that halving event that it actually rallied up 2,107%, right? And, you know, you can argue that was driven from the Bitcoin halving to a point. Anyway, at least it creates the shock to the supply side of the supply-demand metrics. And you can see that we topped out up here, and during this entire run, it was 51,849%. Okay, and it's really interesting. Then we had the initial kind of pull to the downside. It was a three-wave drop. You can kind of see it here. And this actually was 67% in 133 days. Okay, it dropped down. Bounced up, and then we fell down into the actual bear market low, and you'll notice that we stay and in fact bounce on the 1.236 Fibonacci retracement level. Very important, this one. Okay, so as we can kind of see, good run to the upside. Bitcoin halving helped with that, and of course this move to the downside where we have this 86% drop, and we have the bear market low. It was 413 days after the peak, right? Then we go into this next bullish market, right? We start moving on up. Bitcoin halving event happened back in 2016. And you can argue again, you're halving the amount of Bitcoin that you can mine. It has a reasonable impact, but it's not overly that important because the supply has started to increase quite a bit over the years, right? So halving the new minted Bitcoin and adding that to the circulating supply is still impactful at this point, but it's not as impactful. This entire run to the upside was 12,804% in gains. Okay, and again, so you can see here, we've dropped down quite significantly from the 51,000 to the 12,000% in gains, but gains nonetheless. But again, we're starting to see diminishing returns for BTC at this point. And we top out up here, I think it was around $20,000, something to that effect. We can see the initial pull to the downside again looks pretty decent. This particular drop to the downside was 69%, and it was as quick as 56 days. So it was very quick, much quicker than we were previously, and went down slightly deeper. Okay, so 67 and then 69, 133 days, or 56 days. You can then see we bounced up and then we fell down into the actual bear market low point. And again, this looks like a zigzag pattern, a 535. And this one here had the low of 84%. And it was a 364-day run. And you can see we're 86% for the 2015 bear market low versus the 84% for the 2018 bear market low. And the days and the time frames are reasonably close. There's a couple of months in it. So 413 days versus the 364 days. Then we start this next bullish market to the upside. Very, very steep move to the upside. Okay, as we kind of go into 2019, nice healthy correction, the Fed pivot, and we have the COVID crash, and all of that happens right in here, bringing a 72% crash. Okay, and this all happens before the Bitcoin halving event. We actually start to recover quite well after or just before the Bitcoin halving. Bitcoin halving, again, even less impactful now as we had saw previously. And for the most part, when these halving events happen, you can actually see there's a dip afterwards as well. There's a little dip on the Bitcoin halvings. So the Bitcoin halving the supply again, but again, it's less impactful because it only impacts the amount of new Bitcoin that gets minted, right? And there's a huge amount of circulating supply already. So reducing the new Bitcoin is less impactful. It's less impactful now than it was previously. Used to be a big catalyst. Now it's not such a big catalyst because there's still 19 million circulating supply. And whether you're halving the new ones coming into that ecosystem, it really doesn't make that much difference now because there's still 19 million out there out of the 21 million. You can keep halving this down, but it's going to get less and less impactful. Okay. So then we have the bullish market. We have a double peak, very much like the 2013, however, not as steep and not as impactful. Again, we top out at 2,068% in gains. So 51,000, 12,000, 2,000. We can see that there's a rate of diminishing returns. This is pretty obvious because, again, it requires a significant amount more money to kind of move that needle. It requires a lot more demand and it requires a lot more shrinkage of that supply, which you're just not really seeing in an impactful way to kind of keep driving it further forward. So it's unlikely that you're going to kind of see these really, really fantastic gains. Now, I mean, 1,000% gains is still very, very good in gains, right? But you'd have to put a significant amount of money in there if you want to kind of see yourself as a Bitcoin millionaire. You're going to have to probably put in there, sizable amounts of money. Put $250,000 in, you might be okay. For example, you're not going to be able to put $1,000 into Bitcoin and think you're going to become a Bitcoin millionaire. That's not going to happen. And that's pretty obvious here when you see this data running backwards and forwards. And it's pretty logical as well because, you basically look at this thing as an elasticity curve and you'll start to see that actually you get rates of diminishing returns. You can take a look at it here without all the noise and you can kind of see how this is potentially going to be pushing up into that $100,000 level, yes, but it's not going to be necessarily that impactful. Okay, it's not going to be like going to $1 million in the next bull run, for example. But I think it will maybe get there eventually one day, but not until we can see mainstream adoption. And maybe BlackRock is going to be that. So, looking at the history here, it doesn't say it. But then again, we've got new variables such as BlackRock. And we're going to talk about new variables in a second because if we take a look at where we were in the 2018 bear market low point, we can see that we actually came down quite deeply here. As I said, it was 84%, but we did not hit the 1.236. We stayed above the 1.236 on the fib scale. We stayed on or above it on the 2015 low. However, when we start to have this correction to the downside, we actually had a very, very interesting kind of move. In fact, I haven't measured up this one, so let's go ahead and measure it. We had the initial pull to the downside, which was 70 days. Okay, in fact, I'm going to use this one because it's going to be a little bit easier. So we had a 70-day pull to the downside, and it was a 46% move. Okay, so to bear that in mind, we had the initial pullback here at 69. We had an initial pullback here at 67%. Okay, and this one's only 46. So it actually had, a pretty easy kind of easy time of it, right? And we bounced up and then we moved down. This time, however, not only do we have a different kind of initial pullback and bounce, but we also went down deeper than the 1.236. Now, for those who follow Fibonacci sequencing and look at all the different ways of analyzing markets, the fib charts and the fib scales are used time and time again in many different analytical forms. And this is because humans relate and react to the Fibonacci sequencing in many different walks of life, including unintentionally following it through charting as well. And so 1.236 is actually a key level. 1.236 is very key in when it comes to Elliott wave theory and three-wave patterns specifically. Okay, so three-wave patterns typically do not exceed that of a 1.236, and this is very clear when we take a look at these two previous bearish markets where we stay above the 1.236. Then, of course, it becomes quite clear here as well that we were going to be expecting a new lower low, and we're talking about this pretty much from June 2022 all the way through to August 2022, that we were expecting a new lower low. This is because the variables, the underlying variables, were different. You could take a look at all your indicators, you could take a look at all your little lines and trend lines and all those things on the charts, but the Fibonacci sequencing is very, very important. You cannot ignore this. And so what we saw here was a WXYXZ, and that took us down into this low. Now it stayed fortunately above the 1.236, but it did drop down lower than the 1.382. Okay, so this from an Elliott wave theory point of view becomes an W, X, Y, X, and Z, and it was quite clear that a new lower low was going to happen. Now, we don't know the catalyst behind it. You know, we were fortunate enough to catch the FTX saga about a week ahead of time by taking a look at the liquidations of exchanges and seeing that those unusual liquidations were higher than usual. Also, the unusual liquidations that were higher than usual when it came to FTX. So we caught that onto that about a week ahead of time, and we were fortunate enough to kind of say to the community we should probably get everything off of FTX and short FTT and short Solana, short these other ones that were having problems. And so we did very, very well out of this pull to the downside. And this really just comes from taking a look at the data and stop just paying attention to, you know, a couple of candlesticks and actually start paying attention to the things that matter. Data is very, very important, right? Taking a look at lots of different things and trying to build a bigger picture from the puzzle pieces. And so when we start to see this pull to the downside, we had the 1.236 get here, but then we go down here and we did stay above the 1.618. Now at this time down here, I still felt that we had lower to go. In fact, all the way up towards that 25k, I was getting more and more confident that we had another low to come in. Then we started to test up this range here. So this range basically between 28,600 and 32,951. This is the area of previous support that's now potentially coming in, turning into resistance. I still think we have to retrace down deeper. Anyone who's been following the recent videos will know that essentially I'm still thinking $34,000 to $35,000 and then a correction down to $20,000. I don't want to rule out the idea that we go down into a new lower low, because one of the fundamental reasons outside of the charts, if we just take a look at all those different puzzle pieces again, right? One of the puzzle pieces is following the money, and following the money shows us with big participants such as your whales and your Kraken size wallets, people who have, you know, multi-millions invested in Bitcoin. They've been steadily coming out of their positions. They've been coming out of their positions pretty much all the way through 2022, but also in this recent move to the upside that we had in 2023 so far. They've been selling into the pump. So that to me is that puzzle piece just tells me that since they were selling down in November of 2022 down here, that they probably suspect that there's a new lower low to come and they'll buy cheaper down here. Okay, so that's kind of one of the puzzle pieces that kind of says we are more than likely going to have a new lower low, because following the money, at the moment the market's being propped up only by retail investors. Now the big bearish situation that we have here again fits in with Elliott wave theory, is that we do not have a trend-based structured move to the upside here. Yes, there's been some breaks of some really basic analysis things like this trend line, for example, getting broken. And so, you know, because we've broken a line, that makes the whole entire market bullish, right? Wrong. That's not really how that works. Essentially, like, trend lines can be incredibly useful, but they're incredibly subjective to the person who is drawing them on the chart, for example, right? Now, many times, and I've said this many times before, and I'll say it again right now, when we go up into higher highs and to higher lows, yes, that's great. That's confidence building in the market. That helps people kind of FOMO in. I say helps people FOMO in, but it gives people a reason to FOMO into the market. But unfortunately, that does have a tendency to want to break on down. More so when we find ourselves with overlapping corrective structures like this. Okay, so for example, let's take a look at that. What do we see? Well, we can see we had some wick highs here, and some wick lows here. They are overlapping with each other. That essentially tells us that this is not a trend. Trend-based structures from an Elliott wave theory point of view do not overlap. They do not overlap like this, so that basically you have a stronger move. It's depicting a stronger wave. When you have an overlapping movement like this, these are short-term corrective patterns. And so we can potentially push up, as I said, right? And I do see major resistance at $38,000, right? So if we were to try and take out the CME gap that sits up there at $34,000, $35,000, then that's going to test this higher line again. And then I think we're going to break on down from there. So although people get really confident when they draw their trend lines on, they're not really good overall analyzing the market. You have to use more analytical focused tools, in my opinion. Anyone can draw a trend line, right? Doesn't mean you're drawing it in the correct way. And so it's important that we understand that some of the simpler tools, the easier ones to understand, might not be the best ones to actually help you analyze the market. Instead, fragment all your analysis into parts, into components, and then build the bigger picture afterwards. That's how my approach to it. So when we can see here on this market at the moment from a macro scale, we broke above the 250 EMA, we tested the 200 EMA, and we're bounced from there and we're moving up. This gives us great confidence in it being more bullish on the market on the shorter term. Okay, so this now has turned into, from a traditional analytical point of view, a bullish market. Okay, and that would be driven from the idea that we're above the 200 weekly EMA. That gives you great confidence. And the 50 EMA is above the 200 EMA, so again, that compounds that and makes you feel really confident in the market. However, at some point, things do turn, and I do suspect that we are going to see a turn in the market, but probably not until we hit $34,000, $35,000 CME gap. And again, like I said, the 20,000 to 21,000 is the most obvious area. This is a previous area of consolidation. We also tested this previously, and it's where that CME gap sits. So for the most part, that will be where I think we're going to be retracing to on the minimum side of things, right? So for the most part, our market here seems very interesting. One, we obviously knew that we had to come down into the November lows based on the fact that the fib scales were different. We were hoping that we'd get rejected on the 200 EMA, which we did briefly, but we actually rallied on through this. And until the Fed pivot, we're probably not going to see the $20,000 level. Okay, so it does look and give us a little bit of confidence here. But at the same time, we can also see that many altcoins are still bottoming out. They haven't bottomed out just yet, and this is pretty typical as well. Okay, so Bitcoin, historically speaking, bottoms out, and then many altcoins will bottom after that. Now, in 2017, when Bitcoin bottomed, Ethereum bottomed, things like Chainlink also bottomed, but many of the other projects back then did not. So take a look at things like XRP or XLM, for example, Litecoin. They didn't bottom until after Bitcoin had bottomed, okay? And I think that's ultimately what you're kind of seeing. We've seen many altcoins with new lower lows and bear market lows in June 2023, right? We saw that a year after the fact, right? And so it's important that we understand that, yeah, there's still many altcoins that are going to bleed out. Specifically, if Bitcoin comes down towards the $20,000, many of those altcoins are going to be hitting their new lower lows, probably more likely to be their bear market lows. So for the most part, Bitcoin here, I think is progressing quite well. I do suspect that we're probably going to have to hit that CME gap and then go down to 20K. If we do find ourselves with some bearish news or something fundamentally happens that breaks us down earlier, then 20K will happen earlier than expected. But for me, I think right now we can see here that Bitcoin has the potential to have bottomed. I think more and more time it passes makes it more and more obvious that this is the case. However, that one piece of that one puzzle piece, which is essentially that the big players are still not buying into Bitcoin, still kind of paints that picture that maybe things are not quite where they need to be just yet. And of course, the big bearish situation here with the overlapping structure and that move to the downside shows us with a $10,000 to $12,000 BTC price target. And then of course we have this one, right? And if we just connect together, let me bring this back in here. If we connect together the low points and all the high points, well, that would show us with a potential move down here towards $12,000. Okay, so if that's the case, and that's a new lower low, and that supports the idea that maybe these big whale players know that that was actually coming. In fact, it should come down deeper, more towards the $6,000. And in case that is the case, then this curved line would obviously have to reflect a new low point as well, which again would be very, very interesting to kind of see. So guys, I wanted to kind of put this video together just to kind of give you an idea as to kind of where things currently sit on the macro scale. Let me know in the comments what you think. Do you think that we are done with the lows, or do you think maybe we do have to test that $12,000 trend line at the lower side of things? Maybe you're thinking, yeah, $20,000 seems like a pretty reasonable place as well. Let me know what your thoughts are in the comments down below. If you found it useful, smash the like button. If you're new, subscribe, and guys, don't forget to check out Discord. Link is in the description below. Until the next one, have a fantastic day.
We are not financial advisors. None of what we have communicated verbally or in writing here should be considered as financial advice. It is not. Do your own research before investing in any digital asset or affiliate offers, and understand that investing in any crypto is risky. If you do, you need to be prepared to lose your entire investment. This video is for information and entertainment purposes only. All our videos are strictly personal opinions. Please make sure you do your own research and never take our opinions for financial guidance. There are multiple strategies, and not all strategies fit all people. Our videos are not financial advice.